Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Christy.
Hey friends, it's Christy, your credit coach. Thank you so much for joining me for another episode. Today, let's answer the question, is a 700 credit score still a great credit score? As you may know, I'm a mortgage loan officer and lending standards are changing all the time. We've also got a changing real estate landscape and interest rates. Well, it's like a roller coaster for the last few months. Rates going up, rates coming down. And I found that people are generally confused about what good means when it comes to a credit score. So let's cut through the nonsense and get straight to clarity on what is a good credit score. So if you're new to credit scoring or even to my podcast, I want to share with you that credit scores can range from 300 to 850 as far as the matrix. And there are literally dozens and dozens of scoring models. So you might look at your Credit Karma score and apply for a mortgage and find out that those numbers are two very different numbers. So what is a good credit score? Well, according to FICO, which is the most widely used credit scoring model, 670 and higher, well, that's good. Generally speaking, you need somewhere around a 640 or higher to not have to pay through the teeth on interest rates when it comes to an auto loan, credit cards, and a mortgage. And remember, you have more than one credit score. There are actually three major credit reporting bureaus: Equifax, Experian, and TransUnion. Some auto dealerships will only pull one credit score, say your Experian score, and go off of that. But when it comes time to applying for a mortgage, your mortgage lender is going to pull from all three and typically go with a middle credit score. Now, if there's two of you borrowing, say you and your significant other, or you've got a cosigner like a parent or something like that, the lender's going to go off of the lowest middle credit score. So let's say your middle credit score is 700 and your significant other's middle credit score is 670. We've actually got to base everything off of that 670. But here's what's interesting. The average credit score is different by age. Why, you might wonder? Well, a couple of major factors. First, the length of credit history. Would you agree if you're 18 or 21 or even 25, you haven't had as long as a runway to establish and maintain a good credit profile as somebody who, say, is in their 40s? Next, older people tend to have a little bit more financial security, right? They may have paid off those student loans. A lot of times now they're in partnership, and let's just face it, when there's two people paying towards the household bills, it's a lot easier to manage your money than if you are a single person. And hopefully by your midlife years, you have figured out good behaviors when it comes to your finances. So what is the average credit score per age category? The scores in 2024 are slightly higher than the scores in 2023. When I say slightly, if it's changed, it's by 1 point. So let me just tell you the most recent data, which is from 2024. And if you are Gen Z from 18 years of age to 27, your average credit score was 681. Congratulations. You've got good as far as your category. Millennials, 28 to 43, you've got a 691 as an average. Gen X, which is 44 to 59, you're ringing in at 709. Baby boomers, 60 years young to 78, you've got a 746 average credit score. And the silent generation, which is 79 plus, you have a whopping 760. So a couple things I want to share with you when it comes to your credit score current day, if you are thinking about applying for a mortgage. You might be surprised to know that mortgage interest rates are tiered, T-I-E-R-A-D, tiered. So in other words, there are adjustments to the interest rate for about every 20 points that your credit score changes. So if you are in a 680 to a 699, you're going to have this kind of an adjustment, which is a higher adjustment to the interest rate than if you have a 700 to a 719, 720 to 739, 740 to 759. You get the point. Well, not too far back in our recent history, the parameters of the game changed just a little bit. See, it used to be that 740 was the pinnacle number. So whether you were 740 or an 850, basically as high as most of those FICO scoring models go, it was like you were perfect on paper. Current day, however, there are 2 extra tiers that are added, a 760 and a 780. So now you have to be at a 780 or higher to be perfect on paper. So yes, it does feel like that goalpost is moving just a little bit, but here's what I want your takeaways to be. The average credit score, even for our youngest generation, is 680, which is considered a good credit score. The longer that you maintain great payment history, you keep your credit card balances low in relation to your limits, you don't have a lot of unnecessary credit inquiries. In other words, don't apply for a bunch of things that you don't need, because all of those extra credit cards are not like little gold stars in your wallet. You only need 1 or 2, and then keep those long term. Once you close out a trade line being a credit card or an installment loan, it no longer calculates into that overall credit score algorithm, and your length of credit history now gets cut off. So sometimes people think, well, I have a 700 credit score. I should get the very best interest rate. And now you know that there are 4 tiers of pricing that is above you if you have a 700 credit score. But I also want you to know this. Lenders are looking beyond just the credit score itself. There's more to it than just the number. They are looking at your payment history, how many trade lines you have, and even how long you've had those trade lines. So if you've only had an installment loan or a credit card for a couple of months and that's it, nothing else is reported on your credit profile, but you have a 760 credit score, that doesn't guarantee that you will get approved for a mortgage. That lender or underwriter might come back and say, hey, we need evidence of a couple more trade lines for at least 12 months worth of payment history to prove this person's ability to borrow money and pay it back on time. And that's a really easy fix. We could collect auto insurance payments, cell phone payments. Do you pay towards a Wi-Fi bill or a utility like water or electric? 12 months worth of that payment history can fill in the gap. Now, it doesn't necessarily get attached to or added to your credit report. It's usually just for the lender's eyes only, but that could fill in the gap if your credit history is too lean. Now, if you are swimming around in a 680 or 700 and you're like, man, I want to make it to that pinnacle 780 credit score, or better yet, I want mine to start with an 8. Here are a couple of ideas to help you get there. You want to have a nice credit mix. So what is a credit mix? There are 2 main types of trade lines, an installment loan and a revolving account. Revolving refers to credit cards and home equity lines. You want to have at least one of each. And if you want to establish credit and have a nice profile, but without going into debt, I have an episode for that. Scroll back through some previous episodes. There's one that's literally called Creating a Profile Without Going into Debt. If you have credit cards, keep those balances at 30% or below what your limit is. So if you have a $1,000 limit on your credit card, keep that balance at any time below $300. If you haven't had credit history established for too long, you could become an authorized user on somebody else's credit card. I have a whole episode on this that shares all the details, and that can help you create an incredible credit profile very, very quickly and without going into debt. Make sure your payment history is perfectly on time. And just know that the longer you're at this game, that length of credit history and that great track record of on-time payments and being responsible with borrowing money and paying it back on time, that will help you create an incredible credit profile, a higher credit score, and hopefully, in turn, the best interest rates available because you've earned it. Remember, you are so much more than your credit score. But it also feels quite good to see those credit scores increasing over time because of the hard work you're putting into building a great credit profile. Having a lower credit score when you go to borrow money can cost you tens of thousands of dollars of extra money in unnecessary interest charges because you wind up paying a higher interest rate due to a lower credit score. Don't let that be you. Thank you for spending a few minutes of your valuable, precious time to pour into you so that you can know more, to do more, and thus pay less. Thanks so much for joining me for another episode. And until next time, my friends, stay well.
Subscribe now and share with a friend to stay in the loop for new credit content and insider tips to maximize your credit knowledge. And follow Credit Christie on Instagram.